essentially, we offer a complete service encompassing research, planning, buying, building, and management. Milk Chocolate takes care of every aspect of your property journey on your behalf. So we're nationally licensed and purchase properties in all states and territories, excluding the Northern Territory. And we've assembled a world-class team of subject matter experts who span all major aspects of the property journey. So the team is composed of economists, valuers, qualified property investment advisors, data scientists, real estate agents, project managers, interior designers, and property managers, just to name a few. So just quickly, guys, just a little bit about myself. So I've been purchasing, renovating, and selling property since 2006. My role in the business is that I oversee the data and analytics, the purchasing and construction teams. I've assisted more than 350 clients to create, implement, and execute their property goals, and actually personally purchased about 120 properties on behalf of our clients. So nearly 2 decades worth of experience. And then just quickly, guys, on our results to date. So the reason we put that here is because we're really proud of the ability for us to pick rock solid investments for our particular clients. So on average, our clients have achieved 13.63% year-on-year growth since 2016. And the reason we're proud of that is because there's been multiple property cycles during that particular time period. So we've had the APRA intervention, the potential negative gearing implemented from the Labor government if they were going to get into Parliament. You had COVID, obviously interest rate increasing, but over that period of time, the property markets moved in different swings and cycles. So to maintain that consistency just talks to the subject matter experts that we have in our team in order to be able to execute that for our clients. So guys, I'm assuming a few of you are here to want to learn a little bit more about what's happening in the Australian property market. Australians in general have a love affair with property in Australia and want to know exactly what's going on. It's obviously, you also may be getting your news and reports from sort of mainstream data sources, but we also like to make sure that we're providing another point of view that's talking to the actual facts and data of the Australian property market. So this has been put together by our senior economist, Dr. Kevin Huang. He's got a PhD in economics, econometrics, and statistics, and is responsible for our data and expertise. So we're going to do just a quick look around the grounds and understand what's happening in the Aussie property market. And I'll just give you some additional insights as we're going through this. So as you can see on the map here, guys, it's basically just illustrating what's happening in the Australian property market across those major capital cities in terms of the cycles, median price points, change in growth year on year, vacancy rates, etc. So whilst you're sort of just taking into that, I'll just talk a little bit about that. So the current upswing in housing values, it does continue to show strength. So values have increased by 0.4% in August 2024, marking the 20th consecutive month of combined growth since January 2023. Performance does vary, though, across the cities. So as we might be well aware of, Perth, Adelaide, and Brisbane are the top performers with year-on-year growth rates of 21, 12, and 11% respectively over the past 12 months through to August 2024. In contrast, we've got Hobart, Melbourne, Canberra, and Darwin that have all experienced negative growth over that same period of time. And that's mainly driven by the new influx of supply and also reduced demand in those particular markets. Melbourne in particular is also still experiencing some pain on the back of what happened with those extended lockdowns during COVID, and also some new additional tax breaks or tax incentives that the government's implementing, making it a little bit difficult for investors to find some value in that particular market at this particular point in time. But I suppose it's always important to note that the property market does move in cycles, and despite those differences, it's essential to keep broader views about the fundamentals in each capital city. So strong performance in some cities may not last in coming years, whilst underperforming cities could offer better opportunities to enter the market and benefit from future growth phases. So currently, what we believe, we're currently moving into a buyer's market, and this is what the data is telling us, but also what we're seeing on the ground. So from a vendor discounting perspective, that is remaining steady at negative 3.7%. And what that does do, it is reflecting market conditions and the vendor's requirements to negotiate to secure a sale. So what we mean by that is vendors' expectations need to meet buyer expectations now more so than ever, especially when you're looking at the last couple of years. If that's not happening, then we're starting to see properties sit on the market because buyers know that there is small supply coming into the market and they've got a few more options to consider, whereas historically the last couple of years there's been little supply. So that's something that's interesting to note. We are certainly moving into a buyer's market, which is good news. New listings are totaling about 42,500, which is about 2.1% higher than the same time last year and 8.2% above the historic 5-year average. So it just shows you what the supply levels have been basically since that COVID period. It's actually now the highest level of new listings in the first month of spring, also since 2021. So the recent flow of new listings has seen a total listings of rise to 145,000 in the 4 weeks to the 6th of October 2024. And in Sydney at 3.7%, Brisbane at 12.1%, and Perth at 9.4% have all seen stronger flow of new listings over the 4 weeks to 6th of October compared to the same time last year. So really incredible, especially when you're looking at Brisbane and Perth at 12.1 and 9.4 respectively. Those two markets have certainly been leading the way from a cap growth perspective, but we're now starting to see more supply come onto those markets, which would probably mean that those markets are going to cool slightly because there's more options for buyers, whilst buyer demand is still there. And Brisbane, for instance, the total listings in Brisbane are now 4.2% higher than this time last year, whilst advertised supply in Sydney and Melbourne is 6.9 and 7.9 higher respectively. So some interesting data points coming out at this point in time with new supply coming into the market. On the rental side of things, national rent values increased by 7.8% in the 12 months leading up to July 2024, which is roughly double the decade-long average trend of 3%. So this surge is occurring amidst supply constraints and significant rapid population growth, certainly on the back of COVID and those borders opening up again. And although the rental market has shown signs of easing in recent months, vacancy rates still remain tight across the country. Given the current challenges in the construction sector, such as rising costs and labour shortages, expected to take years for the rental market return to that normal vacancy rate between 2 and 3%. So we as a business will generally look at markets where the vacancy rate is less than 2%. Obviously, the last couple of years, basically every market in Australia was less than 1%. But as you can see on the charts on screen, where Canberra is the only market at the moment sitting at above 2% at 2.1%, where you've got Adelaide at 0.7 and Perth at 0.8. And so still significant demand in those particular markets. And generally what that means is the lower the vacancy rates means it's going to be quicker for you to get your property tenanted, which is obviously really important when you're looking at it from an investment perspective. So we believe that that's still going to be the case from a vacancy rate and a yields perspective, and that's what's going to be driving property prices upwards, certainly in the next 12 to 18 months and beyond. So that's just a quick wrap around the grounds, guys, in terms of what's happening at the moment in each particular market. So just moving along to a game plan. So we all know that property is a challenge, and no matter which way you look at it, it can be challenging to understand where to start, where to buy, and what is the best strategy to achieve your property goals. And that's why we've created a product called a Milk Chocolate Game Plan. So as I just touched on, looking at all that information and that data, it can be quite complicated and tricky to understand where is and what's the best time to be purchasing. So essentially the game plan is a property plan that's tailored to your personal circumstances, goals, and risk appetite, created combining thorough research, rigorous risk reduction assumptions, data, and machine learning. So whether it's a single investment or your family home or a long-term investment strategy, will give you a clear, comprehensive plan. And the purpose of the game plan is to help you best understand what your next move can be and how that may impact your long-term financial position. So essentially the way that we talk to our clients about it is think of a game plan as a useful guide or roadmap that exists in the background, giving you insight into what's possible with what you have. And that's a really important piece to that, because not everyone's situation is the same and everyone's circumstances are very different. So we don't just, all of our clients don't just get pushed into a particular market based on what's happening. We still have locations across Australia that we're investing in based on different parameters that we set or what may be required from the outputs of a game plan, such as budget, yield requirements, optionality in terms of what we need to be purchasing, etc. So on this screen here, you can just gives you a bit of a visualization of what that journey can look like. So you would be presented with multiple options, starting from something that's quite light, so it's pretty simple, through to something that might be a little bit more aggressive, so maybe developments, commercial properties, etc. You'll be able to compare those, understand the different dynamics and the economics of those game plans and how they work together, and what could be beneficial for you as a comparison to another particular option, timeline of events, etc. To be able to go through that process and exactly understand what you're getting into and really helping you identify what that journey is going to look like. And really importantly, understanding the decision that you make now how that could impact your future game plan in the future. Because we often get a lot of clients coming to us who've already made purchases, and sometimes the recommendation from our side is to sell those assets because they just simply haven't performed, and the likelihood of performance in the future is going to be null. And so therefore, unfortunately, they have to sell and start again. So it's really important to get it right from the start to make sure you're not making any mistakes. Once the property has been purchased or you're building a portfolio, you can also track the portfolio using our aggregated active portfolio view. So in this particular instance, you'll be able to understand your real-time equity position, the value of your portfolio, LVR, your P&L for your portfolio, so how much money's come in, what's come out, the performance in comparison to the game plan, so how are we tracking? This gives us the ability to course correct if required, pivot the plan. If your circumstances change, we can absolutely make some updates. You can also track everything from maintenance, so CapEx versus repairs. You can break that down into each financial year, which you can then share with your accountant or financial planner. And you can also take a deeper dive into your individual properties as well and understand exactly who your tenant is, when their rent's due, how much you can expect to get next week, etc. So it's a really powerful tool. And the reason why we're talking about it today is because it's a really great tool to have in your back pocket when you're purchasing properties, especially whilst you're living abroad as well. Moving through to asset and location selection. So we've spoken a lot about data, market trends and game plans, but it's also really important to understand and consider the location and asset selection. Likewise, taking into consideration the real estate fundamentals to support the growth of your portfolio. So what I just wanted to quickly talk about was the process that we take. So when we're looking at the game plan, that's obviously telling you from an economical standpoint, budget, yields, etc. But then we go through that process of tailoring the right recommendation. So we'll pair the right locations across Australia that suit the outputs of that game plan. So you'll be able to identify exactly the reasons why we've said, hey, you should be purchasing in Brisbane for these reasons. This is why the other markets aren't currently stacking up. These are the specific suburbs within Brisbane that we can be looking at, and our proprietary scoring mechanisms that we use to help us identify whilst that location is going to be a great performer in the future. You can assess the market against the national forecasting average and also the capital city average. You can take a deeper dive into all the data and analytics, plus also the real estate fundamentals. So you can visualize the type of asset you can be expecting to be purchasing, the reason why we like that particular type of asset, average land size, who your likely tenant will be as well. So it's a really powerful part of the process, but really important to understand that part of the process, because pairing your game plan and the economics to the location is really important to make sure you nail the investment. From a family home perspective, we take a subjective point of view. So you would be telling us exactly sort of where you work, where your friends, family, amenities are, and we'll be pairing the best locations based on your budget spec of the home that you're looking for in that particular area. Looking at the asset fundamentals and what we look for when we're purchasing properties, and this is something that hopefully everyone can take away, is that we use these 4 key real estate fundamentals in location, options, character, and quality. We place about 70% of the weighting on the location, but really importantly, 30% on the asset selection as well. So when we're talking about location, we're talking about where our house is located within that particular suburb. Is it within walking distance to amenities, public transport? Is it on the main thoroughfare road? Is it on the main road? Is it on a cul-de-sac? Is it underneath a flight path? Is it on the high or low side of the streets, etc.? The orientation of the home on the block, is it north facing, south facing? All those things are really, really important to understand when you're identifying an asset in a particular suburb that you might be looking at from a purchasing perspective. Optionality is really important. So we love to purchase properties where you have the ability to add value at a certain point in time. And that might be just a quick cosmetic update, structural, granny flats, development opportunities. And irrespective if you have an appetite to do that or not, or your game plan suggested to do that or not, we'll still try and purchase an asset where you have the ability, where you have those options, because if your circumstances change, at least you have some levers to pull, and if your appetite did change. So that's really important for us to make sure we're identifying assets with that character. With options. Character is really important from our side as well. So we'd love to purchase homes that present with owner-occupier appeal, curbside appeal. Generally, older homes in established suburbs will perform better over the long period of time. They're generally built better, have a lot of charm, wide hallways, high ceilings, those sorts of things are all really important things to consider. And then the quality. So is it a home handyman renovation versus a reputable builder? We'll always get building pest, electrical, plumbing reports for every property that we're viewing for our particular clients. So they're just a couple of key things, guys, that hopefully you can get some takeaways from in terms of how you can identify the right asset to be purchasing. And then when we're looking at just the way that we go about the process, so I've sort of obviously just loosely spoken about the game plans and the suburb identification work, but we understand that purchasing property from afar can feel daunting. There's archaic processes, multiple stakeholders, and a lot of paperwork. So along with our incredible team, the process is managed on a digital platform, and that's providing education first and foremost, but also hopefully building trust, and most importantly, a streamlined process. So on the platform, you'll be able to track everything from the bespoke game plans, the data-driven recommendations from locations and property recommendations, a full end-to-end service through to property management and ongoing active portfolio management. I'm conscious of time, so I'm going to get through this quite quickly. But guys, obviously, if you need a hand, or if you're struggling to be purchasing property from afar, then we'd love to partner with you and work with you along that journey, whether that's for an investment property or for a family home purchase. So I'm going to stop sharing my screen now because I'm well aware I think I've gone a little bit over time, but I'll hand back to Steve for our next speaker.
Thanks, Richie, and it's really great to learn what's happening in the market, as well as the awesome digital platform that Milk Chocolate can offer. So, on that note, now let's get into the financing of the property, especially when you're looking to get a mortgage or when buying a property. So I'd like to invite Nick to talk through what's happening in the mortgage landscape. Over to you, Nick.
Hey, thanks for introducing Stephen. And thank you, Richie, for the interesting dynamics of the property market right now. So as Stephen introduced, I'm a senior mortgage broker working at Odin, and I've previously been working in this industry for more than 6 years now. And talking about my topic today, so we'll be diving into another aspect of your property buying journey, which is financing. So let's just start this one. All right. So in terms of what service that we provide, so we are a brokerage firm. We are a brokerage firm, and we just specialize for expats living overseas. So my special jurisdiction is the Middle East, but we do have other brokers who are specializing in other jurisdictions. And as a brokerage, what we do is we first of all find you the correct solutions in terms of financing based on your local jurisdictions. And even if you're purchasing like your first home or expanding your investment portfolio, or even if you're looking to refinance your existing mortgages, we are there to help you throughout the way, right? Now, why Odin? So what value we provide as a brokerage firm to you? So as I said before, we're the experts on this field because we've been doing this for so long. And expat mortgages, they can tend to become somewhat complicated when you're dealing straight with a bank. So we've been doing this for some 5-6 years, and we've got multiple experiences on how to deal with the Middle East jurisdictions as well. So that's why we're able to strategize your mortgage in a way that the bank understands your jurisdiction as well. So talking about experience, as I said, again, we have a panel of lenders that we work closely with that can understand your local jurisdiction. For reference, there's about 40-50 lenders in Australia. However, only a handful of lenders they can actually understand foreign income, how local jurisdiction overseas does work, right? In addition to that, we also have access to private lenders, smaller lenders, and even non-bank lenders that can usually go into areas which the standard lenders, they won't go into. So if you're in a situation like an out-of-the-box situation, then please come speak to us. There's definitely a solution for you as well. And lastly, it's an end-to-end service that we provide. So we not only find you the right set of solution in terms of your financing, we handle all the logistics for you as well. So from start to the finish, and even after the finish, like when you found the property, we have our own dedicated concierge team who will be looking after your portfolio just to make sure that the product that we've selected for you, it still remains competitive throughout the life of the loan. Okay. Talking about the current landscape of the interest rates, so RBA, the Reserve Bank, they've held the cash rate at about 4.35% just last month. And the rates have been pretty stable since the end of last year. And since 2024, we have not seen any cash rate increases as well. And also due to this stability, like we've seen our internal data, what we've seen is that most of our investing clients are attracted due to this stability. And we're finding more and more investing clients being attracted to the market right now. The average variable rate at the moment is about 6.5%. But us as brokers, we tend to know how we can negotiate with the banks to get better discounts, to get additional discounts on your portfolio. So we can definitely get you below average rates as well. And yeah, if you want to know more about these discounts, then please do speak with us as well. Talking about fixed rates, so at the moment, now as you can see the chart here, it's as per the CoreLogic data based on the last month, so October 2024. As you can see, back 4 or 5 years ago, the interest rates, the variable interest rates, they were comparatively lower than the fixed rates. And we can see that starting early 2022, the rates have spiked a little bit up to a point where variable rates are on par with the fixed rates as well. And what this means is those people who fixed their rates back 4 or 5 years ago, they are slowly coming off their lower rate, lower fixed rate, and rolling over to a much higher variable rate. So this can usually cause stress with the mortgage payments and your cash flow as well. So again, if you're on a similar situation, then please do speak with us. We can definitely help you manage your overall portfolio and manage your cash flow. And on top of that, due to the stability that the rates have, due to the rate stability over the last 10 months or so, and also we've been noticing that some of the major lenders and even non-bank lenders, they've been starting to decrease their cash rates, decrease their variable rates out of cycle. So there's a consensus in the market that rates, they'll likely start coming down sometime next year. So if you're looking to get in the market anytime soon, you please do come speak with us. Now, I'll be sharing some tips for financing in terms of expat financing. So there are two key considerations you have to think about, which is the deposit and the loan. So as an expat, you need to contribute a minimum of 20% deposit, which is actually a good case scenario, because even when you talk like 6 or 8 months ago, you would at least be needed to put down of about 30-40% deposit. On top of that, some of the lenders right now, they're also offering some promotional offers whereby you can even purchase property with 5 or 10% deposit. However, that is case by case. So if you are finding yourself in a situation where you are struggling with a deposit, then yes, we can help you out with that as well. The other thing is stamp duty. So there's a common myth, especially in the expat communities, that you'll be charged a higher stamp duty given you're purchasing a property from overseas, which is absolutely incorrect. As long as you're an Aussie citizen, you'll not need to pay any additional stamp duty, even if you are a PR as well. But be mindful if you're purchasing in New South Wales, because only New South Wales, they levy the additional stamp duty for PR who are specifically buying from overseas. And in addition to this one, so if your partner is not an Australian citizen and if you want to buy together, so there are some strategies that we can adopt in which we can totally avoid the additional stamp duty. And in conjunction, we can use both of your incomes so that we just maximize your lending in the same sense. Okay. Now, the other thing is the quite interesting bit. So one of the common tactic most of our investing clients, they use is leveraging the equity in their existing properties. So if you already have a property in Australia, what you can do is you can access the equity in that property and use that equity for a deposit for the new purchase. So this essentially benefits you if you want some surplus left over after you do the new purchase. Talking about loan scenario, so it basically means how much you can finance from the bank. So it's typically dependent on your income versus the expenses. Generally, as expats, you would be receiving a higher income compared to the Australian market. Like on top of your basic salary, you'd likely be receiving some allowances for travel, accommodation, transport, etc. And on top of that, you'd likely also be receiving performance bonuses or commissions as well. So it's very crucial to identify those lenders that can actually understand these type of income, because not many lenders would actually use these variable incomes. The second most crucial, no, not the second most, the best thing about applicants from the UAE is the 0% income tax jurisdiction. So again, this is the most crucial factor for identifying the right bank, because again, as I said, majority of the banks in Australia, they don't realize the local jurisdiction and they start applying Aussie tax rates to your income, thereby reducing majority of your borrowing capacity. So essentially, you have the best ideal bank to go with is a bank that can actually understand that you don't pay taxes at all. The other thing is you can get same rates as Aussie residents do, like local residents do. There's no differentiation in products or features or anything else. The only differentiation is where they treat your income. And what I mean by that is, so let's just say, for example, you're earning about 100,000 Aussie dollars. When the lenders, they actually take into consideration, they only take about 70 to $80,000 of your income. So they discount your income given you're not earning Aussie dollar. So that's about the tips. Now, moving on about how the general process works as an expat is when you're dealing with us. So first stage is the assessment. We collect some information from you, just a preliminary information, and then we do a overall market research in identifying the correct set of banks. And once you're happy to proceed, we just start collecting the relevant documents. And then our backend team, they will handle everything for you, including submitting your application to the bank. And once your application is submitted, we then move on to the approval stage. So getting the approval is generally about 2 to 4 weeks. And once you have the pre-approval, it is valid for about 6 months. So you basically can go on and offer for properties within that 6 months period with having the confidence that the bank is ready to finance you. And another important aspect of pre-approval is the pre-approval actually hedges you against any policy change risk as well. So if a bank gives you a pre-approval today, and let's say in a month's time they change their policy or they stop lending to expats, this pre-approval will secure your approval basically. So they won't deny the pre-approval for you. And then once you found the property, there's a settlement. So as an expat, the settlement process is usually complicated and can become overwhelming sometimes because there's just a lot of documents to complete, multiple set of contracts to execute and witness as well. So to handle that process as well, we have our own settlements team, and they will be guiding you throughout the whole journey, meaning they'll be instructing you on what you need to sign, where you need to get your documents or signatures witnessed. And also, if you have trouble finding the eligible persons, they can actually refer you to our partners as well, who can do it for you. And lastly is the concierge team. So after your property has settled and the property is yours, so it's not that our journey ends here. So even after the settlement is done, we just ensure throughout the year, throughout the life of the loan, that your loan that we selected for you remains competitive. That involves conducting semi-annual reviews, negotiating better rates with the bank on your behalf, and doing a market research as well, just to identify if there are any other better alternatives in the market. So yeah, having said that, just sharing some exciting news. I'll also be in Dubai from 12th to 15th of November. So if you guys are interested in talking about this, I'd actually love to take you out and know more about your situation. Now passing over back to Stephen here.
Yeah, thanks, Nick, for sharing tips on financing, and also for those who are in the region during the week of November, please do reach out and say hello. Well, on that note, let's move on to talk about managing your wealth and protecting your assets. Over to you, Dave. Dave, I think you're on mute.
Yeah. Okay, can you see the right screen? That's the question. Here we go. Sorry. So let me rattle through a couple of the early bits of this, but obviously it's important to take in your wider financial considerations for property investors. And St James's Place, we are a FTSE listed company. It was founded in 1991 in the UK. We have 185 billion sterling clients' monies under management. So we are the largest wealth management business in the UK. In about 2013 and 2014, we started to expand internationally with Singapore and Hong Kong, and more recently in the Middle East in Dubai. Hopefully future coverage will also include Australia. And we provide highly personalized face-to-face wealth management, which these days is a bit more rare given the technology attack, I suppose, but face to face is kind of what we're all in this business of, and it's a far superior way of getting your outcomes. Look, we cover, like I say, Singapore, UAE, but the tax element is really important. So we have in-house UK and Australian tax advisors that will work in conjunction with looking at all your other assets aside from just the investment assets you hold with us, but when working with Odin and milk chocolate, etc., on your other assets, and holistically putting that all together, which is where you get that overall viewpoint. Now, I think the key area that I wanted to touch on today, when you look at property investing, is actually protection, and protection being sort of insuring the asset or insuring yourself. And it's, as far as the key foundations of financial planning go, it sits there at the very foundation of it. In a hierarchy of importance, protection is the starting point. And then we get to wealth accumulation, preservation, and when you get into your retirement and beyond, we start to look at how you can protect that and pass it on to the next generation. But everything really starts from a protection point of view. So why is protection important? Well, we actually insure a lot less valuable things in our lives. Some of those are mandated, like car insurance, and in the UAE, you certainly have to have medical insurance. Home contents and travel, maybe we choose to do, but these are sort of transactional, sort of low ticket things. But often we fail to recognize the importance of the most valuable asset in the family, and that can be where the income comes from. You know, whether that's a husband or a wife or a partner, or whether it's both of you, and what would happen in the event of that income being lost in a very kind of non-emotional manner. The replacement cost to those income streams is high, and we'll get on to exactly sort of calculating or working out what to insure down the line. It can be an incredibly emotional time, obviously, when someone passes away, and I think the worst thing that could happen would be to have additional stress and additional worries that occur around money at that point. It can be hard enough, life can be challenging enough at that point, rather than also worrying about financial situations. So it's an incredibly emotive period of time that you can at least remove one element of stress from. And that financial preparation knowledge of planning the future without that income stream can be, you know, really, really important to understand, plan for, calculate, and ensure that actually you're not in a total loss at that situation. And particularly with regards to retirement, I think most people, well, retirement can be interlinked or changed with financially free. And I think most people would tend to be accumulating towards that goal throughout their lives, whether they intend to totally retire or just get to a point of financial freedom. And if that life is cut short, or you're prevented somehow from continuing to add that value in, then you need to replace that. You need to completely fill that gap that's been left behind.
Hey Dave,
yeah.
Sorry to interrupt. I think your screen's frozen. It doesn't seem to be moving.
Oh, okay. Let me run. Is that better?
Yeah, we can see that.
Okay, let me run through the slides in this way. But it was showing up on the other screen. Apologies in the technology side of things. So with those plans, obviously there's going to that gap needs filling. So it really is a case, and it was something that my father used to teach me as a child, partly because he was in the life insurance industry. But you can see it like taking your sunglasses or your umbrella out with you, but it's better to have it and not need it than the alternative of needing it and not having it in place. And that's really what insurance is all about, and protecting those outcomes that you hope don't happen, but of course they can. So let's take a quick look at the types of protection and what they mean, and maybe what might be most appropriate. I think for most Australians with superannuation, a lot of people tend to purchase insurance through their superannuation, and that can be for a number of reasons. The first one being it's easy, and it doesn't hurt your back pocket immediately because your super seems like it's paying for it, and that's a lot easier. A couple of things to really consider there. The first one is if you are not resident in Australia, then there's a significant chance you are not covered by that insurance. And the last thing you want to be doing is paying insurance premiums that don't cover you in the event of claim, because you think you're protected, you're wasting money, and then all of a sudden disaster of not being covered. The other thing that we typically find with insurance through super is that it tends to come out as a guaranteed renewable insurance. And what I mean by that is when you're younger, the risk is lower, so your premium is lower. And when you're older, the risk of death increases obviously significantly. And often we find that the type of protection within a super increases, the cost will increase with age. So you might think, oh, it's great, it's nice and cheap now. As you get through down the line, that gets compounds, and compounds, it gets more and more expensive. Whether that's every year, every 2 years, every 5 years, that insurance premium can ratchet up to the point where you might consider not paying that insurance anymore when it gets too expensive, at the point in which you're most risk. So I think there's a great danger in guaranteed renewable insurance. Often in Australia, people might have permanent health insurance or income protection as well, which, although can be perfectly useful as far as injury rather than death, often can be very difficult to claim for, and fairly difficult to understand, but can be very useful to replace income to make sure you pay your mortgage. So that can be something to consider. What we really want to focus in on, I think, for most people, tends to be term assurance. And term assurance is exactly what it says on the tin, really. You choose a term. And typically, if you're insuring your own property that you live in, let's just say you choose the term of that mortgage, or you choose your term until retirement, or you choose a term until your kids have finished education and you can be financially free. So let's say that's 20, 30, 40 years, some people, however long that might be. And then you pick a level of protection. Let's just say you choose $2 million and a term of 20 years. So you'd have $2 million of cover that anytime that you would die within that 20 years, that would pay out $2 million of cover. So the sum assured remains level. So that $2 million doesn't change. Equally, your premium. So let's just say it costs you, for argument's sake, $200 a month. That stays level throughout that period of time. So when you get to the end of the term and you're still alive, I mean, just be grateful you're still alive, and that insurance would cease. That would no longer protect you, but you should be financially independent. You probably paid off your mortgage. You're probably in retirement. And at that point, you probably don't need protection. So that's really the simplicity of level term assurance. It's decreasing in its own nature because it will not increase with inflation. So over 20 years, you can imagine the erosion of value that will happen with inflation. But equally, during that period of time, one would assume that you're naturally accruing and building your wealth to cover that gap. So your other property acquisition, other growth in the property, other investment, savings, wealth accumulation within that. Historically, you could have, many years ago, less so these days, have had decreasing term assurance, which actually, if you were buying your own property and staying in it for the rest of your life, a lot of people might have done years ago. And typically these days, people don't tend to stay and live in the same house for most of their life. But you'd have said, okay, my mortgage is 25 years. The term of the insurance is 25 years. My mortgage is $2 million. We're going to have decreasing term assurance that starts off at $2 million and decreases its way down to zero in line with that mortgage over that 25 years. Great in theory. Reality is that people chop and change on their mortgages and their property, take equity out, etc., and that changes, and therefore it becomes not quite a matching thing. Critical illness, that's a living insurance like permanent health insurance, income protection. In the event of being seriously ill, then you'd be paid out a lump sum. Very important to consider. We're far more risk of that than we are of dying during our working lives. And there's plenty of instances where you might not be able to work and cover your costs and things like you used to do, often preferred over income protection or permanent health insurance. But very, very much worth considering. Employer protection, whilst that's great, so life insurance, etc., provided by your employer, it's a good benefit to have. The family would be very grateful. You don't know how long you're going to be with an employer. You might go self-employed or change employers with less benefits. And if that's the case, you need to take personal protection later on. Your costs are going to be higher the older you are. And also there's a risk of insurability. So if you've had some serious illness or serious problems occur during that time, you may not be covered at all, or indeed your premium could be much more expensive, or certain illnesses could be excluded. So how do you value the loss? Well, I mean, there's some rules of thumb, and obviously everyone's situation is going to be different, but just little things to consider. You take a multiple of earnings. So if, let's say, you've got one earning partner in a relationship and you've got property together and children, etc., and you lose that life, you've got a multiple of earnings there that you're going to be losing out on over the years. Now, you can also then take into, whether you look at 5, 6 to 10 to 12 times earnings, that will just become, that needs to be drilled into on an individual basis. But essentially, gather together future costs, education, mortgage, etc., and then your deficit from retirement planning, and all the debt like mortgages, credit cards. Put that together, and you at least at a minimum want to be covering that. Property debt. So specifically, if you've got a property portfolio, which you're building successfully, you've used leverage, which is great, but at that point your reason for having a property might move from growth to income. Then you're going to want to cover off the debt in order to start receiving the income to live, rather than investing for growth at that point. How long do you set the protection for? Typically, as I said, the term of the mortgage, years to retirement if you're on plan, or till the kids are no longer on the payroll, which maybe never, but hopefully when they finish education. So know your why. So, as part of a portfolio, the reason you're attending this webinar is because you're interested in property, and property can be magnificent as an investment because of the use of leverage for growth, yield for income. There's some predictability in it and fundamentals, particularly if you take milk chocolates and data analytics into account. It's not as simple as going a section of your assets should be in property, a section in fixed income, and a section in equities that's fixed, or a section in cash. Everyone each to their own on their attitude for risk, etc. But all I'd say is beware of concentration risk in any investment. So I'd say that with equities, you wouldn't want to put all of your money into just emerging market or the Magnificent Seven. Equally, you wouldn't want to put all of your, you wouldn't want to have an entire property portfolio located in one suburb of Melbourne. You would diversify and spread that concentration risk around. I would sometimes argue that you need make sure you have more than one asset class. And whilst property should be a very important part of your portfolio, make sure you balance it out with other assets and think about things like liquidity. And when you're talking to Odin about the mortgage, think about, do you have a mortgage where you can draw down more if you needed to in a certain period of time, access to capital, or do you have to hold that cash or more liquid investments elsewhere? And always, and I would always say this, be very aware of tax. Tax sits at the heart of what we do. We're very tax optimized, tax focused wealth management. But don't always let the tax tail wag the dog. And what I mean by that is a good investment can be a good investment, but just make sure that you're optimizing it from a tax point of view, but don't make tax the sole reason why or why not to invest in something. And in order to expedite the session and not take too long, I think you probably understand what putting it all together and what is financial advice, but that's what we do. And we build it all together. We forecast, take it on a holistic approach, stay up to date on a plan, have a plan, make sure you're geared up for your future tax residency, if that's going to be Australia in the future, or if it's going to be somewhere else. Make sure you start planning for that now, because the earlier you do, the better the outcomes can be. And sometimes we actually save people from themselves with regards to having someone there that can understand the behavioral finance around market movements, etc. And that's it then from me. Thank you very much.
Thanks, Dave, for the comprehensive walkthrough of managing and protecting the wealth. For those who have missed out the first part, we'll share the slides afterwards.
Sorry about that.
So moving on, lucky last. So Pao, would love to hear from you on the tax implications as an expat.
Right, thank you, Stephen. Can everyone see my screen? Yeah, cool. So let me give hello from Hong Kong first of all. To all the attendants. I'm Pao. I'm a partner at Odin. I run the tax team at Odin. My background is I came back from Sydney about 10 years ago to Hong Kong, and since after I've been doing tax for expats when they're living overseas as a non-resident for tax purpose. And what we do at Odin, from simple stuff like helping you to submit a yearly tax return, show you're compliant, you're not late, to a more high-level tax advice in terms of how to utilize your time better while living in the Middle East, enjoy the zero income tax, and how to better utilize your money for investments and what are the tax implications on different investments. So in the future, maybe about repatriation back to Australia for kids' education, and maybe in a longer time, once kids are independent, you might be thinking of coming back out again as an expat. So we look after on the whole process, even though there might be a time when you're back in Australia, we can assist you from that angle. Today I want to just quickly make sure I'll go for a few points for being an expat living in the Middle East, what that means. And like Dave, what something Dave mentioned, which I totally agree, is planning is the key. So get to know what happens, what your situation is, and then do planning is the key way to save your income earning from the Middle East to be completely not taxable in Australia. And that kind of fall back to the tax residencies. So I won't go too deep into what is tax residencies, but generally if you're living in the Middle East, living your life there and not really returning to Australia, you are generally to be treated as a resident for a non-resident tax purpose in Australia. If you want to go deeper into your personal situation, we can have a chat later. But what it means is, as a non-resident, you to update you about debt status, make sure you're compliant. They understand you're a non-resident, so your income not being taxable in Australia, and also to avoid the penalty if you're late. A lot of cases is when you left, you thought you don't need to do anything because you no longer live in Australia. But the truth is, ATO doesn't know about the situation, so there could be a penalty they still apply on you because you simply haven't lodged anything and update ATO on your story. So this is what we can help. Make sure your record is up to date and make sure you're protecting your situation, your income, and just report whenever you have in Australia. So as a non-resident, so simply your application to Australia is any income that you're still getting from Australia. Most expats would have properties, interest, dividends. So those would be the income that we need to focus on and pay tax on. Different rules can apply, 10% on interest income, and dividend is on another 30% withholding tax. So really depends on and what you are getting on. And another thing is if you have a student loan tax in Australia, you also need to require to report your earnings in the Middle East to calculate how much you need to pay back on the tax. So it doesn't go away because we had a rule change back in 2017. They now require you to report and start making repayments. So here is the threshold. So in this financial year, the rate has been slightly changed. Bigger threshold, a wider window, and a lower tax rate. When it comes to property, simply planning the key. What you want to understand is the process of cost of buying the property. And when it comes to managing the property, what is deductible, what might be your positions, your yearly positions, and to the end is the capital gains. So For anyone, if you're holding Australian passport or PR, if you're looking to buy in Australia, generally you'll be treated like normal Aussies in Australia. You won't be penalized on anything else. But just to look out for if you're PR of Australia, living overseas, but you're looking to buy in New South Wales, rules are slightly different. They are the only unfriendly state to PRs living overseas, so you might want to double check on that point. Because otherwise, you might be exposed to the additional 8% stamp duty surcharge. But in general, most states charge you around 5% stamp duty, and you only need to pay the legal fee, 2,000 to 3,000. That should be able to help you complete a purchase in Australia. Nick mentioned one thing about before was what if you are married with a non-Australian partner? So there's the workaround in terms of tax and mortgage. We can still have plans to help you avoid paying the additional surcharge, but still able to secure the mortgage for you and also not expose you to additional fees. And one thing I want to mention is about land tax. So land tax is kind of hidden tax. A lot of people have not thought about it at the beginning stage of buying a property. They will be surprised when they receive a bill from land tax office, state revenue office. So land tax is a state tax. Every state has their own rules. And for PRs or foreigners, the rules are slightly different as well. There's another land tax surcharge which may apply to you. And again, Sydney, New South Wales, they are the hardest ones. So you want to make sure you understand the rule completely. So what we do at the beginning is we make sure you understand the rules. One of the investment strategies is to diversify your investments in different states to utilize or facilitate the threshold of each state that give you on the land value and land threshold. So that's one of the methods that you can help to bring down your costs. Because land tax is the annual fee. Once you trigger the land tax, and you pay it every year. And when it comes to maintaining the properties, negative gearing still applies on expats. So you can still use the negative gearing to offset the income from the property. So likely you will be in a loss positions if you are thinking of getting a 60, 70, 80% mortgage. So this is where you can then accumulate these losses, and these losses won't go away, won't expire. It's indefinite. You can use them either when you return to Australia, start working, you get employment income, or when the property becomes positive after a couple of years, or when you sell them eventually, that you have the capital gains issues. And lastly, about some rule change of being an expat. So keynotes, since 2012, rule changed for non-residents. We don't really get the 50% discount when it comes to capital gains calculations. So whatever you make after 2012 as a non-resident, it is subject to tax 100% at your marginal tax rate. There's another rule which is about the withholding. If you're selling your property for more than $750,000, and while you're a non-resident, you would need to pay a 12.5% withholding to the tax office. And there are a few ways to mitigate these rules, which is you can either do a variation if your record is up to date, you don't need to pay that much, probably only need to pay like say 2.5. We can help you to do the variation with the office so you can get most of your money back at settlement. Otherwise, you need to wait until you submit your next return and calculate and see how much you can get back in terms of refund. So again, time is running, so I'll probably stop here. Just quickly go over in terms of the eventual buying, holding, and selling the properties. I'll probably pass on back to Stephen, so see if we can have some time for Q&A.
Yeah, thanks so much, Pal, and thanks for keeping on time. Yeah, so we did have some questions that have come through the registration, and maybe given the time, we'll probably just take one question and answer the rest of the questions after the webinar through email or blog. So the question that we have, and I think this might be for you, Pal, it's from Stephen. So the question is, from a tax and investment perspective, do you typically encourage the use of SPJs for property investment in Australia?
So this question depends really, whether you need finance? That's another question. And this is one of the main reasons why we combine mortgage and tax into one business to help people who are looking to buy property in Australia. Because you also need to consider when it comes to a special purpose vehicle, can the bank lend under that structure? And the short answer is not really. The banks in Australia, they tend to lend to a simple structure, either like a individual name, sometimes trust, but again, limited options. Those two are really the vehicle that the bank can look into. But if you don't need the mortgage, would it be any beneficial of using these vehicles? Potentially, yes, but really depends on personal situations, whether you'll be returning to Australia or you'll be staying overseas for a long time. So I can't give you a definite answers, but possibly yes. But really depends on personal situations.
Cool. Thanks, Pal. Well, I guess, Steve, if you'd like to know more details and get some personal advice, yeah, come and talk to Pal. So on that note, thanks so much, everyone, for your presentation and everyone for your time. So what we'll do is we'll wrap up here and we'll send out the recording and the slides over to you. And also we'll post the questions that we have not been able to answer today. But again, if you have any questions about Australian properties, please do reach out to Richie to learn more about how Milk Chocolate will be able to help. And for those who would like to learn how to better manage and protect your wealth, please come and talk to Dave. When it comes to getting a mortgage through Australian lenders, come and talk to Nick. And lastly, to learn more about tax implications by investing in Australia, please come and talk to Pal. Thank you very much, everyone. Have a good day.
Thank you, guys.
Thanks, guys. Thanks for hosting, Steve.